Hi everyone, and welcome to the Streetwise Property Pulse, your resource for Ontario's real estate investment and financing updates, where we bring to you timely updates and perspectives from leading real estate practitioners, answer your burning questions, and share with you valuable tips and strategies. This is Dalia Barsoum from Streetwise Mortgages. On today's episode, I am answering two of the most common rate-related questions that clients are currently asking, especially given the low-rate environment and the economic outlook. The first question is, should I go fixed or variable? The second question is, if I am locked into a high fixed rate mortgage a few years ago, does it make financial sense for me to break the mortgage and switch to a variable rate? Let me start by sharing some context around where the rates are likely heading in 2021 and beyond. As we all know, rates have dropped to historical lows due to the pandemic. With a second wave underway, unemployment on the rise, and many parts of the economy impacted by the government's restrictions, the Bank of Canada has committed to keeping its overnight target rate low until the economy is on the mend, and the economic slack from the pandemic is absorbed, which is likely to be late 2022, early 2023. The Bank of Canada's overnight target rate drives the bank's prime rates, on which they base the pricing for variable rate mortgages and lines of credit. Given the Bank of Canada's rate plans, it is expected that the variable rate mortgages will remain low and stable until 2023. There are also predictions that the Bank of Canada will further cut the overnight rate in its upcoming meeting. On the fixed rate front, unlike variable rate mortgages, fixed rates do not depend on the Bank of Canada's policy. They are dependent on the government bond yields. Fixed rates are currently at historical lows, and the premium that you have to pay for the security of a fixed rate is also at historical lows. Bond yields started to go higher in August, and economists are expecting it to continue to rise so long as the economy shows stability. The 5-year fixed rates therefore are expected to also rise, although they will remain relatively low compared to the past 10 years. So, which path should you take? Do you take a fixed or a variable rate? Yes, you guessed the answer. It depends. Here is what you should consider. If you're considering selling or refinancing the property during the term of the mortgage, then do not take a fixed rate mortgage, as fixed rate loans often come with hefty penalties when you break the mortgage before the end of the term. But you may say, Dalia, can't I just port the mortgage to a new property if I sell the current one and buy a new one? And can I just refinance with the same lender without breaking the mortgage if I need to? Yes, you can, but here is the fine print. Even if your mortgage is portable, you have to requalify to port, and the lenders often have a window during which you can port. For example, some lenders would allow a port only within 90 days of the sale of the property. As for a refinance, if at the time of refinancing your income, credit, or portfolio changes, or if the lender had changed their lending policies, then you will be forced to break that loan to explore other alternatives if you don't qualify. For real estate investors in particular, I recommend taking a variable rate mortgage, as it gives you flexibility to recycle equity to grow your portfolio. For homeowners, if you have no plans to sell and you are looking for stability in your monthly housing costs, as well as the peace of mind that comes with a fixed rate mortgage, then consider a fixed rate. Whether you choose a fixed or a variable rate mortgage, it is important to read the fine print in regards to the conditions under which you can exit the loan and the penalties associated with that, as well as the prepayment privileges. Let's now move on to question number 2. Is it worth your while to break your current fixed rate loan and switch to a variable rate? Again, the answer is it depends. We always look at the cost-benefit analysis of this exercise, and we have to run the numbers to make a final decision. Here is what to consider. Number 1, breaking a fixed-rate mortgage comes with a penalty. We need to find out what that number is and factor in all of the costs associated with discharging the loan from your old lender and switching it to a new lender. Number 2, taking all costs into account, we create a new mortgage at the lower interest rate. Keeping your monthly payment the same, we then compare where your old mortgage balance would have been, staying with your current lender, compared to the new mortgage balance at the lower rate. Many clients have saved thousands in interest over the new term of the mortgage as a result of the switch. In some cases, however, the switch did not make sense, where clients were looking to break in year 1 or 2 of locking into a fixed rate mortgage, or where the interest savings did not offset the cost associated with breaking the loan. If you would like to revisit your current fixed rate mortgage and see if there is an opportunity for you to save thousands in interest through switching to a lower variable rate, my team and myself would be happy to help you crunch the numbers and make an informed decision. That's it for today, folks. To get notified of our new episodes, please subscribe and hit the bell button. I'll see you on the next episode.